finance, a la shmup. What is the Barron's Confidence Index? Well, Barron's is an old-timey publisher of Wall Street data, and today it's a stodgy magazine catering to sophisticated financial readers. Well, the magazine has fiercely opinionated readers, and it began to take advantage of them. First, with simple, old-school polls managed by its journalists before computers were really a thing. And then it began to codify and index the densely packed brain power that it was surveying as to where the markets and the world was heading. So one outcome of this outbound research effort was the Bond Index, or Barron's Confidence Index, which is calculated by dividing the average yield to maturity on what is generally AA and AAA grade bonds by the average yield to maturity on what is generally BB-ish grade bonds. Got it? So AAA, AA over the BBBers. All right, well, why would you do this strange calculation in the first place? Well, it reflects its audience's attitude about credit risk. The presumption among pretty much everyone is that the safe bet, i.e. U.S. government paper, is just a reflection of inflation more or less, and everything else, or at least all other credit, is pegged to that very safe U.S. paper. So it sets the standard against which the riskier credit is measured. It's stable. Since the Barron's Index is a bond risk index, it is, in essence, a calculation of its audience's confidence in the U.S. economy relative to everything else. And generally speaking, in a good or growing economy, there are very few bankruptcies or defaults. Why? Well, partly just because times are good and people are buying, stuff. Yeah, even stuff like that. And if a given company individually stumbles, well, there are often competitors who are doing well and who would likely acquire that company, maybe not for a huge premium, but at least they'd pay off the company's debt. So it'd be money good, right, for those BBBs? So its bonds, even if lowly rated, would go back to par and everyone would get paid off as planned. So the index isn't an absolute measure of anything, really. It has to be viewed relative to wherever it was trading last week, last month, last year. When investors are confident, the spreads for bond yields are narrower and the ratio is higher. All right, well, think about the intermediate bond yields. Well, when the ratio is high and increasing, it means that faith in the economy is growing, right? Because that denominator yield shrinks because grade BBBs, instead of having to yield 12%, yield like 10 or 8. And inversely, the ratio is lower and decreasing, demonstrating less faith in the economy when things go the other way. And when the economy is really in the toilet, well, expect to hear a lot of this sound.